Okay, guys, so today we'll cover a topic that may actually be very relevant for many of us who actually own properties. So, the question is whether or not she should prepay part of her mortgage loan. So, I'm going to use a real life example based on actual numbers that she has provided me. So, today, for the purpose of illustration, we'll be looking at her 2021 mortgage loan. So, the characteristics are as such, right? So essentially, she took a mortgage of about 890K. So, and then it was dispersed at 2021 January. So this is basically the mortgage amortization schedule. So let's fast forward to today, right? So today is essentially today is around February 2025. So essentially, the let us look at the interest payment here, right? So interest payment as a proportion of the total monthly uh, mortgage installment is about, it's about almost half, right? So today, if you look at the monthly installment, it's about $4,000, and the interest portion actually comes up to about 50% of the mortgage. And for this mortgage, it's on a fixed rate basis, so it's about 2.95%. And so I think we asked the question of whether or not we should prepay part of this mortgage. So the loan outstanding as of today is around 790K. So, in the next tab, I actually uh, uh, put in an assumption of about 200K. So essentially, if today she has about 200K in cash lying somewhere, she would ask the question or not, should I actually use this cash to prepay a portion of my loan? Or I can actually use this money to invest, right? So if we fast forward to today, she can actually make a prepayment of 200K. So I actually link this cell to E18, which is essentially this number over here, 200K. So 200K will reduce her loan outstanding to about almost 590K, right? So essentially, as you can see, the mortgage, the interest payment proportion will actually drop from almost 2K to about 1.5K per month. So obviously, like, these amounts would come up to around 220K. So as compared to if we actually do not prepay, the total interest over the life of the mortgage, the remaining mortgage term, will actually be almost 300K. So I think let's just summarize it over here, right? So I've summarized the facts in this tab. So the total interest saved if she were to prepay a portion of the mortgage would be about 75,000. So this interest is saved over about 22.75 years loan tenor remaining. What if she actually invests the 200K into some other form of investments, right? So I just put it at about 5%, because I think like 5% is quite a reasonable number if you, let's say, you invest it in the S&P or the Nasdaq. So after about 22.75 years, this is actually what she would be getting. So it's about like it's almost a tripling of the funds over here. So you can see, like, we're just compounding this over the course of 22 years. So essentially, like, if she actually invests this 200K at 5%, she would actually make, okay, actually the return here is probably incorrect, because the return is like 606,000 minus 200K. So it's more like, so I have this like super complicated formula here, as you can see, but I think this needs to be about 406,000 over 22.75 years, which is essentially this number here. 500 plus K is actually the difference of this and this. So actually, if you look at it, right, we should be actually comparing 400K with this amount. So it's actually more like 300K. So okay, I think because the formula is a bit complex, so I'll probably amend it later. But you can actually see that if you actually invest this money elsewhere, even at 3%, right, you actually still do make this amount of your capital is well, actually your investment return would be this amount minus this amount, right? So 191,000 is still better than 75,000. If you ask me, it's almost like more than double the return, because this is the sure return if let's say you prepay your mortgage, and this assumes that the interest rate path does not change. So obviously, if like interest rates were to drop, then of course like the interest saved will actually even be further reduced, and of course like it just means that it makes a lot more sense to actually not prepay, because you could have invested the money at a much higher rate of return, right? And I think it's not that unreasonable for young people to actually invest their capital in the market, in the equity market. So other qualitative angles I see to this is that if you actually have this amount of money, it can actually be sort of like a rainy day fund, and instead of actually prepaying this amount into your mortgage, which is it is going to be a more illiquid asset to liquidate when actually you need the money. So I think from just my own personal opinion, I think that if you have this amount of spare cash lying, you should probably invest it in other more liquid assets, which potentially could yield a higher rate of return over the course of your life, and it will also serve as a cash buffer or cushion if in the event, like in today's job market where layoffs are very common. I think having spare capital is actually a huge stress remover, because obviously like in tough times, right, in a situation where people lose their jobs, they can actually still tap on their more liquid form of assets. And even if you don't invest in this amount, right, looking at like 75k that you can save over 22 or 23 years, that doesn't seem like a very huge amount. So I think with that, I think I'll end the video. So if you guys want to see more videos involving finance topics, please hit me up. Please drop a comment, like, share and subscribe, and I hope to see you in the next video. Thanks.